Okay, so now that you are well prepared with all of the information you need, let's look at the impact of refinancing and the factors involved in making the final decision whether to refinance some or all of your education loans. Your private loans may have come with incentives or benefits, such as a rebate for making a certain amount of on-time monthly payments, or receiving an interest rate reduction for automatic payments. If you refinance, these benefits may no longer be guaranteed. If you also have federal loans, they come with some benefits that may or may not apply to you. Some examples of those benefits are loan forgiveness programs for certain professions, the option to postpone payments based on financial hardship, and a wide variety of payment plans. Did you know that through the federal loan program, there is a payment plan that bases its required monthly payment on your income? So, if your income is substantially low, your monthly payment could be significantly reduced. These benefits and protections do not transfer to private loans. As part of the refinance loan application process, you will be presented with a summary of the federal benefits you may lose and what benefits your new loan may come with in order to evaluate the financial impact to your budget. For both federal and private loans, there may be tax benefits that come into consideration as well. As you can see, if you plan on refinancing your student loans, you need to know which benefits you will be gaining and which ones you will be losing. We have included a downloadable resource document that will give you even more detailed information on all of these benefits to be aware of when making your decision. Next, let's talk about your credit rating. It's important to remember that your interest rate and fees will be determined based on your credit worthiness. For example, let's say the current interest rate on your education loan is at 5%, and the potential interest rate for the new refinance loan could range between 4 to 6%. This would mean that with a strong credit rating, you could benefit from a lower rate than you currently have. With a weaker credit rating, your rate could actually increase, and you may not want that even if one of your goals is to have a lower monthly payment. One of the most enticing reasons to refinance is to lower the amount you pay each month. While this may be helpful in a financial bind, paying less each month may extend the life of the loans, which means in the long run you will be paying more money in interest. So, you must carefully balance the short-term benefits of a reduced monthly payment amount with the longer-term implications of paying more in finance charges over the life of your loan. Let's say you have 5 years left to pay on your loans and you have a high monthly payment. For example, by extending your loan from 5 to 10 years, your monthly payment may drop. The loan will take longer to pay off, and due to interest, you will likely spend more money in the end. Extending the term of the loan is not always a bad thing if the lower payment is needed for your current financial situation. As an example, you may be approaching a large financial milestone, such as trying to qualify for your first mortgage, starting a business, or saving for retirement, and your current education loan payment makes your monthly debt load too high. This might be a good reason to accept a longer term with a lower monthly payment. Since there are no prepayment penalties, if your financial situation improves, you will be able to pay these loans off quicker and avoid some of the interest. Remember, the federal loan program offers a number of monthly payment plans to fit your financial situation, including some based on your income. You will want to compare these closely as you evaluate your options. If you already have a low payment with your federal loans, refinancing might actually increase your monthly loan payment. For most people looking to refinance their loans, having just one monthly education loan payment can be enticing. Refinancing both your federal and private loans would allow for one monthly payment instead of paying multiple lenders each month. As enticing as having one payment might be, you should consider all of the options we have discussed. Leaving your loans where they are, combining your federal and your private loans together into one loan, or refinancing only your private loans. Only you can decide which is the right choice for you. This may seem like a lot of information, which is why we have included a downloadable resource document filled with all of the detailed information and examples you might need when considering the refinancing of your education loans. You will also be presented with additional detail personalized to your financial situation as you move through the application process. Now that you know what your options are and you understand how it works, you can now better assess whether refinancing is right for you.